Thanks for joining us on this web conference to discuss the FOMC meeting overnight, as well as the ongoing situation in the Middle East. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And in the next 25 minutes or so, I'm going to go through the latest messages as well as the forecasts from the March FOMC meeting. What does that mean for investors? And of course, in the context of what's happening in the Middle East right now. And at the same time, I will go through the latest developments in the U.S. Iran conflict and again, the market implications. Of course, as always, you can ask questions via the website interface. I'll try to get through as many of those as I can on this call. So let's start with the Fed. Look, no change in policy rates as expected, 3.5 to 3.75. I think that's pretty much in line with expectations. Only one dissent in the votes. Stephen Miran, who has been voting towards the dovish end of the spectrum since he joined the FOMC late last year. And obviously the situation in Iran is creating quite a bit of uncertainties when it comes to policy making. That's very much the emphasis from Chair Jay Powell's comments during the press conference. But before we go to the press conference, I just want to quickly touch on the latest summary of economic projections, the Fed's or FOMC's own forecasts on growth, inflation, unemployment rates, as well as policy rates, which typically gets a lot of attention from the investors. In terms of economic growth, GDP growth for 2026 is revised up 0.1% to 2.4%, and then for 2027 revised up by 0.3% to 2.3%. No change to the unemployment rate forecasts. And also for the headline inflation PCE, both the headline inflation and the core PCE was pushed higher to 2.7% for 2026 and 2.2% for 2027. Again, I think this partly reflects both the impact, the lingering impact from tariffs, as well as the risks of higher energy costs as we get through this particular crisis. Now, in terms of the rate forecasts, 7 out of 19 forecasters are forecasting no change to policy rates for this year, and then 12 out of 19 are forecasting at least one cut. Some obviously are voting for more or predicting more in their forecast. So I think overall, it doesn't really change the overall projection of how we think the Fed could be moving policy rates. We still expect maybe one cut before the end of the year, but obviously the timing of that has been significantly pushed back because of the U.S. Iran conflict. If you look at the futures market, the first cut has been significantly pushed back to the July of 2027. So it's not even this year, it's going to be next year, according to the futures market, pricing in fully for the first rate cut. So I think the key message from these set of numbers is that the policy rates are likely to be unchanged for the first half this year, as well as going to the second half. That, frankly, is not that different from our initial thinking before the U.S.-Iran conflict, because don't forget, we enter 2026 with quite a bit of momentum in the U.S. economy. The capex, especially relating to AI, continues to be strong. And meanwhile, a lot of households are expecting to get tax rebates from the big beautiful bill from last year, whether it's in the form of tax rebates on tips or overtime or Social Security or state tax rebates. So I think in that sense, we were expecting already a bit of a fiscal stimulus boost in the first half of 2026. That may slowly wear in the second half, but obviously growth momentum and arguably inflation momentum was likely to be sustained in the first half. That really ruled out rate cuts by the Fed. But obviously, with oil price now over $100 across the world, the inflation pressure, gasoline continues to be rise. Gasoline price in the U.S. continues to rise. That again is creating additional headline inflation pressure on the U.S. economy. Now, in terms of the press conference by Chair Powell, I think he did stress quite a bit on the uncertainties when it comes to the inflation outlook because of the uncertainties coming from the conflict in the Middle East. And he also stressed that we should not read too much into the Fed's forecasts. So obviously, I still genuinely believe that the committee members use their best judgment based on economic data rather than political intention, and therefore, their view I still value significantly. But I think it's also worth just taking notes of Chair Powell's comments that no one really knows how this geopolitical event will unfold, and therefore the risks of these committee members will have to review, revise, and change their forecast in the months ahead continues to be significant. So I don't think we should be necessarily pinning our investment strategies purely on the dot plot or the Fed's forecast. I think we should just be humble in terms of understanding the uncertainties ahead of us. But I think the key point he did also mention that long-term inflation expectation is still contained. That seems to be a key factor in driving the expectation for or keeping the possibility of rate cuts alive in this environment. Chair Powell did mention that a few members discussed whether the next move could be a hike. I still think that's unlikely given where policy rates are right now, and also the fact that we could be looking at slower growth momentum, weaker job markets as we proceed through 2026. But obviously, after the high inflation era of 2022 all the way to 2024, I think many central bank officials, not just the Federal Reserve, but central banks around the world, are more sensitive towards inflation risks as we speak. Now, another point which would have made headlines in any other day, obviously we're not in any normal environment at this point, is that Chair Powell mentioned that he will not step down as the Fed governor. Now, Chair Powell's term as the chair ends in May. Kevin Walsh, who's nominated to be the next Fed chair, he will need to be confirmed by the Senate. We don't quite know exactly when that confirmation hearing will take place, but Chair Powell did mention that if Kevin Walsh confirmation hearing is delayed or for any reason he cannot take on the chairmanship in May, he will extend his chairmanship until Kevin Walsh is confirmed by the Senate. But at the same time, he will, at least for the time being, retain his role as one of the Fed governors. He mentioned that until the Department of Justice investigation over the Fed on the refurbishment of the federal headquarters is over, he will remain as Fed governor in order to provide support and clarity and transparency. Whether after the investigation is over, whether he'll step down, that remains unclear. So I think, again, in terms of the Fed's personnel changes, is likely to be fairly minimal in the coming weeks and months ahead. And that, again, should help to shore up investors' confidence on the Fed's independence, at least for the near term. So just to next on to update on the U.S. Iran conflict in the Middle East. So we had a call last week on the situation. Back then, our argument was munition market sensitivity by the Trump administration, as well as the upcoming midterm elections, is likely to persuade the U.S. administration to really claim victory quite quickly and then de-escalate the situation. Obviously, since then, we've had a number of developments. For example, the U.S. and the Israeli coalition continues to attack Iranian military targets. A number of senior Iranian officials have again been killed in those attacks, and at the same time, Iran continues to retaliate with missile and drone attacks, not just against U.S. military targets or U.S. military establishments, but also increasingly towards oil and gas production and logistic facilities across the Gulf states. All of these could add to the risk of two things. One, the Strait of Hormuz could remain restricted or obstructed for a longer period of time. I think that very much is the trump card in Iranian government's hands. And at the same time, the fact that some of these oil facilities are under attack and being impacted, that also means the risk of production resuming to normality quickly could also come under risk. So that's partly why we've seen energy prices move higher on the back of these developments, not just in the Brent crude, but also if you look at, for example, the price benchmark for Oman oil price benchmark, that continues to move higher because that's where the direct impact from Middle Eastern oil continues to be. So I think that in that sense, while there's still a strong incentive for the U.S. government to de-escalate, to contain the situation, I think what continues to happen is the risk of supply of oil and gas, as well as the logistics being disrupted. The risk is this may actually be extended a little bit longer than expected, and that can continue to keep energy prices higher for just a bit longer through spring, through the summer months, as we enter the second quarter. So what does that all mean? Well, first of all, if you look at the immediate reaction in the markets overnight on the Fed meeting, we have seen bond yields move higher, especially towards the shorter end, the 2-year. I think, again, the fact that market's pricing out a rate cut this year, not that we agree with them completely, but the fact that market is expecting more limited room for rate cuts, that is pushing up the short end of the yield curve. U.S. equities and also Asian equity this morning reacted pretty negatively to the news that we're not going to get much relief from the Fed as well. Interestingly, gold fell below 5,000 and the dollar bounced back above 100 for the dollar index. So we've seen, again, the ongoing demand for liquidity is being supportive of the dollar, but gold continues to fail to act as a safe haven, despite very significant geopolitical concerns in the Middle East. So this is where we are, and where do we go from here? Now, as we've argued for the past 2 weeks, geopolitics does have an impact on markets in the short term, but whether it's in terms of 9/11 or the Iraq War or other geopolitical conflicts in the past, historically, these events tend to have a short-term impact, but unlikely to have really a long-lasting effect on market volatilities. I still stand by that view, albeit that I think the initial expectation that this can be contained quite quickly, the risk of that being extended is on the rise. As mentioned earlier, both the Strait of Hormuz under pressure, under obstruction, but also more importantly, oil facilities across the Gulf region is being impacted. So I think that runs the risk of volatilities being a little bit longer compared with previous events. But ultimately, once we find a point of de-escalation, I suspect market risk appetite will gradually return. So the overall view of equities over fixed income, or the more pro-growth, pro-risk tilt in portfolio construction continues. Now, the other question that we've been getting a lot from clients over the past few weeks is how does the current episode compared with the Russian invasion of Ukraine back in 2022, which you all remember back then, oil price moved again significantly higher on the back of the Russia-Ukraine situation. And as a result, that led to a significant spike in inflation. Now, obviously, the geopolitical elements can be described as quite similar. Obstructions or supply disruptions that lead to a shortage of supply relative to demand. But I think there are some significant differences between 2022 and 2026 that we definitely need to take into account. For example, if you look at the growth dynamic in 2022, we were coming out of the COVID pandemic. Therefore, air traffic or tourism, a lot of the business sector were just really at the early stage of recovery. And therefore, you've seen a pent-up demand being released, but a lot of these services were not able to return to their pre-pandemic level of operation quickly. For example, airlines cannot resume their flights frequency as before, or hotels will still have to recruit people to really serve and also to run hotels. Hospitality, F&B industries, many service industries went through the same challenges, which led to additional inflationary pressure. And then back then, you also have extremely loose monetary policy. Central banks around the world cut rate aggressively to protect the economy from the pandemic. And also fiscal policy was being very aggressive to help people out during the period of the pandemic. And that all that put together on top of the Russia-Ukraine conflict really created a perfect storm of inflation, and therefore central banks have to then turn around from ultra loose to very aggressive policy in very short space of time. That created significant pressure on both the fixed income markets as well as the equity markets, and that led to a very difficult investment environment in 2022. In 2026, yep, we've got higher energy prices, and arguably we're going to get higher food prices too, because the two go hand in hand, but we don't have the same upturn in the economy. Growth around the world was stable, was steady, but it was not coming from recession to significant amount of pent-up demand being released as the first thing. Monetary policy started this conflict, I would argue, in most places being neutral or slightly below neutral. Definitely real rates are positive in most developed economies and emerging markets, whereas back in 2022, real policy rates were negative. And that again is a significant difference. Fiscal policy, many economies, they do run deficits, but the fiscal impulse in driving economic growth is much weaker compared to 2022. So I think we are likely to see some lift in headline inflation because of higher gasoline or petrol prices as well as food prices, but a lot of the underlying drivers of high inflation back in 2022, frankly, is absent at this point. So, from that perspective, we have seen a similar market trend with both stocks and bonds under pressure in the last week or so, but the magnitude clearly is much more modest compared to back in 2022. And at the same time, I suspect that once the geopolitical situation comes under some form of control, you could well see both markets start to recover from that standpoint. So obviously, in the short term, there could still be some pressure depending on how the Iranian government react and their action towards the Gulf states. But if I take a slightly longer term time frame, once the geopolitical environment start to stabilize, I think some of the more positive growth fundamentals once again take over, that should provide a more constructive backdrop for risk assets. That includes equities and as well as corporate credits. But I think another point to bear in mind is, of course, in this environment, alternative assets, things like transportation and infrastructure, real estates, again, tends to provide a decent amount of stability in this geopolitical environment. So if you think back to 2022, obviously commodities not surprisingly did perform well because of high energy prices and food prices, but a lot of alternative assets tends to be low correlation with equities. They also did reasonably well, especially with things like transportation and infrastructure, which much of the return comes from consistent income rather than valuation or capital gain or capital price movements. That again generated more stability for investors. Now, of course, other areas how we can get through this period of volatilities, income continues to play a key role. If you look at, for example, high yield corporate debt in the U.S. spread did widen to some extent, but not significantly so. But with a 6 to 7% income or yield, again, that provides investors with more consistent income generation despite higher volatility in equity and in some bond prices. The other thing to bear in mind is we've been talking about options overlay strategies relating to equity strategies. Again, I think in this environment of high volatility, that could also be quite valuable to investors, where by selling options, generating options premium, again, you get that relatively consistent income stream despite the volatility in the underlying equity markets. And of course, with high market volatilities, you should expect to generate higher option premium as well. So in that sense, I think there are, again, a number of solutions that we can tap into despite quite an uncertain world as we speak. So overall, yes, it's a challenging world. Yes, as Jay Powell said, there's a lot of uncertainties. We don't know how this could evolve in the very short term, but I think the key principles of investment, staying invested, being well diversified, and really make use of as many tools as you can to generate income, to look for low correlation opportunities. I think these are, again, very important in this particular environment. Thank you very much for joining us today. As always, if you want to raise questions to myself or our investment experts, please reach out to your JP Morgan Asset Management client advisors. We will have another call for our second quarter guide to the markets. That should be the second week of April after the Easter break. We'll give you more about asset allocation in the second quarter. Hopefully the situation in the Middle East will calm down by then, but if not, obviously we'll also discuss that as well. And I'll see you in April. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.